My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I've been one of my friends. I'm just trying to make some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CBC or tweet me at Jim Cramer. Once the high flyers fall apart, they become almost impossible to value. There's a schism between high valuation stocks and the rest of the market, which is exactly what we saw today. Dow gained 215 points, S&P was roughly flat, while the more richly valued NASDAQ tumbled 1.33%, and one point was down a heck of a lot more before short covers came in to close out the day. When you see these kind of tech meltdowns, it makes you kind of tear your hair out. It makes the reason I don't have any left. You look at the declines in Snowflake or Salesforce or CrowdStrike or Okta or Zscaler, and you figure they must be screwing up big time. But that's not it at all. High-flying tech stocks are plunging for the same reason the big industrials and bank stocks are soaring. We've got a sector rotation on our hands. It has nothing to do with the companies themselves. It has everything to do with the nature of the street. This rotation has more to do with volleyball than the fundamentals of the companies that are plummeting. While I hate to say I told you so, for the last couple of months, I've been warning you to transition out of these high-price-to-sales stocks before 2022 because the new year would not be kind to them. I made that point very importantly multiple times on our club call. I didn't know it would be this vicious, though. Take a stock like Okta, which we know well. This identity verification software company has fantastic revenue growth but loses fortunes. A year ago, Wall Street looked at the revenue growth and was willing to pay a huge premium. Why not? Okta is the #1 identity business. Their sales have quadrupled in 4 years. They've made a brilliant move to own the whole space, which is why they've been able to spend a lot of money for greatness. As long as Okta kept beating the sales estimates, the analysts would keep raising the price targets, and the stock would go higher still. Momentum. But that was the old market when the Fed was your friend. Now the Fed is your foe, and Wall Street's got a new set of preferences. Suddenly, money managers want actual earnings per share, which Okta does not have. So no one who owns this thing knows how to value the stock of Okta. The stock can't possibly fall low enough to be cheap, at least some sort of PE basis. The result, Okta's going into free fall, and I have no idea when that fall will be broken, even as the stock's down 80 points from its high. And remember, the company is fantastic. I don't mean to pick on Okta. We all know anything can bounce. There are literally dozens upon dozens of these nosebleed valuation stocks. Okta's just among the best of them. At the moment, though, that makes it the best house in an awful neighborhood. Now let's talk about the opposite, John Deere. They make the best equipment needed to dig things, haul things, and plant crops. When I wanted to move around some massive 5-inch slabs of wood from a gigantic dead ash tree last week, we brought in a Deere to do the job. When I wanted to create a path where the tree used to be, I used my Deere backhoe. And when the infrastructure money gets doled out, a decent chunk of it is going to go to Deere. Fortunately, Deere only trades at 16 times earnings, not sales. Unlike Okta, which has seen its share count balloon from 106 million to 155 million in the last few years, Deere has shrunk its share count from 324 to 308 million. It pays a small dividend. That can grow. Most importantly, Deere is a prosaic, generic, well-run machine company that has the wind at its back thanks to both the infrastructure bill and a massive new farm cycle. Above all, Deere is easily understood. How about Okta? Many share owners own this one only because they think it was going higher, momentum. They don't have the first clue what it actually does beyond making Oktas. And now that Wall Street's no longer willing to value stocks on a price-to-sales basis, they don't know what to pay for it either. Or more accurately, they don't know how low it can be sold, when the selling will stop. There's no buyback, no dividend, no floor. Deere, on the other hand, has a defined set of shares, a possibly growing dividend, and the strong possibility that Wall Street will be able to reward it with a higher price earnings multiple because of the ag cycle and the infrastructure bill. The stock is roughly 5% cheaper than Caterpillar on an earnings basis. No wonder it jumped 6% today, the polar opposite of what we've been seeing in the NASDAQ. Now let's step back from the world of tractors versus identity management software so we can focus on interest rates. Hedge fund managers have a very similar and simple playbook that they follow religiously. When rates are headed higher, which they are right now, you have to abandon the stocks of companies that are valued based on what we call the out years, what they can make far into the future, because that future is getting less enticing. High inflation means the value of these future earnings will be eroded, and they've got no dividend that can outrun rising bond yields. Instead, at this point in the business cycle, the playbook says you have to go with more tangible companies that make real things and generate real profits, make things, get paid for them, profitable. Conceptual is out, tangible is in. So what's that mean for these two groups? Well, at this point, if any of these conceptual companies has a revenue shortfall, their stocks will be obliterated. There's zero margin for error. Tangibles? Market's very forgiving. Boeing's a serial screw-up. They've had problems, let's see, with the 787, the 777, the 737 MAX, their military contracts, you name it. Yet the stocks rallied more than $10 this week. This morning, some analysts squawked that 2022 will be a year when Boeing gets its act together. I live in hope. But at this point, the stock can rally regardless because it's back in style on the Wall Street fashion show. Yet another reason we own it for the trust. And if it actually gets some orders, wowza! Let me give you another example. Ford Motor. Today, Ford came out and said it can make 150,000 electric F-150s. And believe me, like with Tesla, there's demand for a lot more. For the longest time, you couldn't give this stock away. Nobody cared about CEO Jim Farley's bold predictions for the electric pickup truck. By the way, he made them on our private broadcast in the Charitable Trust Club. Now, though, the market suddenly appreciates an old dog that's doing new tricks. Ford currently sells for 12 times earnings, even after today's 11% jump. I think it deserves a much higher valuation. Oh, I don't want to slight GM. Big interview with Phil LeBeau tomorrow, Mary Bauer, which rallied $4 in its own right, despite fourth quarter sales being down more than 40% and losing the U.S. sales crown to Toyota. Well, that's someday. There are other stocks that are flying with nothing going on, like Wells Fargo. Investing club name will benefit from higher interest rates, very inexpensive. Wells broke out for a second day. The stock of J.P. Morgan got slashed from buy to hold this morning, soared $6. Honeywell, one of my favorite companies, saw its stock get downgraded today with some comments that made me feel like management's out to lunch. Totally untrue. Yet the darn thing didn't even skip a beat, rallying more than $2. That same analyst suggested GE would be a better buy. Well, they could certainly do a lot worse than GE. Of course, it's not as simple as tech versus non-tech. There are plenty of cheap, tangible tech stocks out there, IBM, Hewlett-Packard Enterprise. Again, though, these are easily valued businesses that have a John Deere-like feel, and that's what you need. Look, interest rates won't go straight up, even as bond yields are ripping today. The Fed may not put through 4 rate hikes this year. But the bottom line, Okta versus Deere is the best way to understand this market. Okta, Deere. No, it's not U.S. versus Holmes, where Theranos defrocked hero looks like she may be headed to jail. However, Okta is guilty of something. It's guilty of being expensive. And maybe that's the only thing that matters in this market.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.